If you look back, and I do certainly follow this very closely, in around 2009, there was a big switch. Central banks had been gold sellers up until that point for a couple of decades and became net gold buyers in around 2009. And to me, that's not an accident. You look at that year, and that's when we were in the midst of, I guess, at the tail end of the great financial crisis, 2008, 2009. And the financial crisis was peaking. And then you have central banks becoming net gold buyers. To me, that absolutely means that they were watching very carefully what had happened. They were starting to lose faith in the financial system in many ways, which sadly they themselves are in many ways responsible for. But, I like to say, do as they do and not as they say. And central banks having become such clear, important buyers of gold tells me that we all need to do the exact same thing, and we should be our own central banks. And we should look at buying gold as well. They saw what was happening. They see what's been happening with inflation. And, we had a very clear and sort of scary events. When precious metals do especially well, it's nice to be prepared and to benefit from it. It's just unfortunate as to the reasons why they're doing well, but that doesn't mean you don't want to be part of the group that's prepared. I'm not convinced that banking crises have ended. And I think that central banks, clearly saw that, are on edge about it. They think that we're due for a monetary reset, and they're accumulating gold. And that's why I say, we need to do what as they do, not as they say. The other thing to look at, I think, in terms of providing at least a floor, and what I consider a rising floor under the silver price, is industrial demand. And that's an interesting thing about silver. Really, there's no equal to silver, because silver is both an industrial and a monetary metal. You really can't say that about any other metal. Gold's market is about 8 to 10% industrial. The rest is some kind of investment demand, whereas silver is about 50-50, about half industrial and half investment. So that's why I like to say that industrial, because it's so steady, it helps to provide a rising floor under the silver price. And then you've got the investment demand that starts to be the wild card. And when you get into these periods of strong investment demand, then that's when you see the volatility start to move up. And then that's when you start to see these sudden run-ups in the silver price. What is reassuring to me is in the last couple of quarters or so, I've heard numbers from credible people, credible analysts. And so it's making me sound almost conservative these days. And something important I think that listeners may want to know about, if they don't already, is something called a gold to silver ratio. And that you can calculate that easily any day. All you do is you take the gold price divided by the silver price, and that tells you how many ounces of silver it takes to buy an ounce of gold at any given point in time. So the ratio in the last sort of 20 years has averaged about 55 or 60. Today, we're above 80. When the ratio hits 80, goes above 80, or starts to drop back, falls back below 80, tends to be a really good time to buy silver. Now, in that environment, gold and silver tend to both do well. It's just that silver tends to outperform gold in that kind of an environment when the ratio is falling. So to get to $300 silver, I'm going to give you two examples. So what I did was I looked at the last bull market, which was at the end of the 1970s. In 1980, when gold reached about $850 at its peak, silver reached around $50 at about the same time. So if you do the ratio between 850 and 50, the ratio had fallen to about 15, which is pretty much the lowest low it has been in matter of at least decades, if not centuries. So I said to myself, okay, in this cycle, when we ultimately reach a peak in gold and silver, if the ratio were to get back down to 15, what could that mean for the silver price? So first you have to decide what it'll mean for gold. And I've been saying, going back, since about 2009, 2010, that I think gold will ultimately reach at least about $5,000. So if you do 5,000 and you use a 15 to 1 gold silver ratio, that's $333 silver. So I round down and I say, based on the gold to silver ratio, we could reach at a ratio of 15, we could reach $300 silver. Another ratio again that I use is the is the silver to average US home price ratio. So back again in 1980, that ratio had reached about 1,400 or so, let's say 1,500. And that's 1,500 silver ounces to buy the average US home. So if we look at the average US home today, we're going to say it's roughly about $450,000. It's interesting to note, by the way, that at the opposite end, so when silver was at its low of about $4 in 2001, it took about 55,000 ounces of silver to buy the average US home. Today, it's about 15,000 ounces of silver to buy the average US home. But if we go back to a low of 1,500 ounces of silver, and at today's average US home price of 450,000, if you divide 450,000 by 1,500, which was the low again in 1980, then you're looking at a price of about $300 silver again. So both of these ratios, when they've hit their lows, both times you get $300 silver. What was really sort of revealing or telling to me was that the different examples I used all ended up pointing to about a peak of $300 in silver. I mean, it could be below that, it could be somewhat above that, but I find it silly to go somewhere too specific. That's why I think, a round number 300 sort of basically made sense to me, and that's ultimately my peak. And I don't expect silver to go there, stay there. That would be in some ways probably, even catastrophic depending on the environment for multiple users of silver, manufacturers that consume silver. But I do think that in some kind of a mania phase, we could easily see that kind of number reached. I think the de-dollarization trend is real. I think anybody and everyone who's listening right now needs to know about it and needs to understand it. It's not complicated. It's just that, right now the US dollar is considered the world's reserve currency. It's what most central banks hold as a foreign currency, as a reserve in terms of a safe haven asset. It helps in multiple ways. They can help support their own currency if they need to by using dollars to buy their own currency if for some reason it goes through a period of weakness. But the whole thing with the dollar is that since we've been off the US dollar gold standard since 1971, despite that, the dollar continues to dominate world trade. And, that's really been the case despite being off the gold standard since Kissinger cemented the petrodollar deal with Saudi Arabia, which was that, the US would provide protection to Saudi Arabia if they agreed to only sell their oil in US dollars. So that was a genius move. It helped to create constant demand around the world for US dollars. But despite that, the dollar's been on decline for, I'm going to say, at least the last decade or so. And, you've seen the US, unfortunately, abuse its privilege with owning and running the world's reserve currency.